Hello, and welcome to another Dolphin Financial Radio Show with me, Dan Wendell, owner of the Dolphin Financial Group. Today's topic is CDs, certificates of deposit. We're going to talk about using them in retirement, if they even are appropriate, or using them at all. What are they? What are the pros and cons? What are the current rates? And some tips and tricks on how they apply to people near or in retirement. And to join me and talk about that, I'm going to invite and bring in my co-host here, Tony Shore. There he is. He's got CDs. Tony got the message that we're going to be talking about CDs today. But as usual, he didn't realize what type of CDs we're talking about. We're talking about certificates of deposits, not
compact discs.
Compact discs.
You didn't even know what You didn't even know what the other CD stood for, did you, Dan?
No, I did.
Compact
In
disc.
fact, I do have. So I recently got root canal, literally.
Ouch.
And as I was
Your
sitting in a
speech is
chair-
pretty good today, considering.
I know. It's been a few days, so I'm fully recovered. But while I was in the chair, I thought about the show we did on dentists, dental insurance. I'm surprised I don't have dental insurance, but if you can watch that show, I'll put it up here on dental insurance, especially in retirement. So I know how expensive this could be. But I was up sitting in the chair, I'm like miserable. I'm awake, but I could, they're sawing at, drilling into my tooth. And I thought about CD rates. I thought, what could be worse than this? And I thought, CD rates could be worse.
What could be worse than a root canal? CD rates. That's funny. Yeah, in fact, Dan, the latest CD, I still buy CDs. I'm one of the few freaks that still buy CDs. This is the latest CD I got. It's a brand new release, posthumous, of course. It's Frank Zappa's last live show in the United States ever. It's the full show on CD, 2-disc set. But this 2-disc Zappa set, I think I would have to, and I know we're going to get into this, but in order to cover this, I would have to have a CD for years and years and years just to earn enough interest to buy this CD.
And where does that interest go? Does it go to Dweezil Zappa?
It mainly goes to Met and Diva, who run Met Zappa. His brother runs the Zappa Family Trust, but then supposedly royalties go out from there. Yeah.
So a CD. That's pretty funny, Tony. We're going to talk about the other types of CDs, though.
All right.
CDs,
All right. Sorry.
Certificates of deposit.
Yeah.
So basically,
you had
I
a
want
root
to talk
canal.
about. Yeah,
you want to talk about the root canal?
I don't want to say root canal because you say rut canal, and I don't even know what you're talking about. Are you in a rut? Yes, it's
root
canal.
There's
2 O's in
yes.
there. Okay. Not a U.
Root.
So let's talk about
canal.
Let's talk about CD.
Okay.
Real quick, CD is a certificate issued by a bank or a credit union typically, and they give you interest. You give them money, they give you interest. Okay. And Tony, right now, I know that CDs are paying 50 times as much interest, more interest than a savings account. So that's pretty darn good. 50 times.
No, because
they are.
What's 50 times 0?
Well, no, it's. I think the CD, the savings rates in America are about what the banks are offering is probably 0.02%. So 50 times that is 0.5%. That's pretty good, right?
Yeah. Yeah.
See, but you can play on words, right? Oh, I could get you 50 times the interest you're getting now. Yeah, well.
Wow. Yeah. And there's probably some less than trustworthy financial advisors saying things like that, or banks out there telling people things like that. The banks.
We can give you, a 0.01% interest in a savings account, but we can give you 50 times that in a CD for 3 years. 5%, 0.5%. 5%. What'd you say? 5%. Did you say 0.5? No, I said 0.05. Oh, wait.
Yeah,
So
really.
so you give the money to the bank. They pick a preset time, typically, as low as 3 months, which is, not a lot. 6 months, year, 2 years, sometimes three. You can go even further, probably. I wouldn't even bother looking, but I don't know what the current rates are right now. I haven't looked in a while, but the longer you go out, the higher the rate is. Um, you spend most of the time on our podcast on surfing the web.
Yeah,
So
I do. I
so
do it.
could you do me a favor and just currently check what the rates are? And we're looking at late June, early July of 2021 for the listeners that are watching this on replay or
Sure.
listening on the podcast. What
Sure.
kind of rates we looking at for CDs right now?
Okay. Well, first of all, Dan, I'm going to give you the rate, the highest savings account rate you could get right now, and this is the highest. This isn't the average. Is
This is
point
not
five.
CD, this is savings.
This is savings. You can actually get a 0.5 savings rate, but there are qualifiers, etc. It's a special offer, but you can get a 0.5 savings rate.
0.5 savings rate.
Yeah, 0.5. That's 0.5%. But CD rates, the best you could get is on a 2 year is 0.75%, maybe 0.8. And these are the best CD rates for June of 2021 right now, this month, per bankrate.com. And the best 1 year is 0.7. So you can't make 50% more on a CD than you can a savings.
Well, Tony, I think it was Steve Martin that said this. I know banks that'll give you a quarter of your money back. So if you give them $1,000, they're going to give you a quarter of that back as interest. Like if I win the lottery, if I win 20 million, I'm going to give a quarter of it to charity. Quarter meaning 25 cents.
Oh, oh no! I should have had the. I'll tell you what, that joke. I should have went with the
I think
crickets.
Steve Martin said. No. You know what Steve Martin said? While I'm on jokes,
It's
I know
your
that
delivery.
$1,000,
Uh-huh.
they'll give a quarter of it back to you. They're not going to give you 250. They'll give you 25 cents at the bank.
That's better. Okay.
So no, but Steve Martin said, why is it that you expect when people give advice, they give you the 2 cents. Here's my 2 cents, but you only get a penny for your thoughts. So it's a bad deal, and that's kind of what's happening at the banks, right?
Yeah.
Oh, look at this! I can get a mortgage for 2%. I can get an auto loan for 1.5%. I'll take that all day,
Right.
But what are the banks? So you're paying them 1.5%, 2% at a really, really good rate. But what are they giving you in return? You just said it, 0.7? 0.7 for 2 years?
0.75 for 2 years for a 2 year CD.
And I'm
It's
sure
not-
that's like
Yeah.
some random internet bank that,
Yeah.
So, but let's talk about the CDs a little bit more, pros and cons, because these can be useful. So I want to give them their fair share of props. Okay, so let's talk about the pros here. A CD, first of all, it's insured by the bank, so you get the FDIC insurance. If I loan you money, and I'm gonna pay you, you're gonna pay me 2%, which is a lot better than I can get at a CD.
Yeah.
But you're not insured. You can run with it. You'll probably run with it. You'll buy, CDs on it.
Albums, CDs. Yeah.
Oh man, that's just a really bad loop right there. So the bank has insurance, so you're safe in that regard. Another pro would be a higher fixed rate, higher rate than savings. So you just said it. You could get a 0.5% savings. That's not normal. Most banks are 0.05 at checking savings.
Well,
right?
Bankrate lists these, and I don't know if these are special rates, but it says you can get a 0.50%.
It's probably at an
savings.
internet-only bank without tellers and things like that, and that's fine. So, but but for most banks that you work with the retail shops that you can walk into, if they're even open right now, you're getting 0.2%, 0.02,
Yeah.
0.05.
Yeah.
So you
The,
get a
the
higher
thing is,
rate with a CD.
yeah, they're actually, Citibank is offering it, but the little asterisk says rate available in select markets. So
Right.
I don't know if you're in Honduras right now, but you can.
Right. Right. Or you have to maintain a balance of 500,000 in the checking, or the
Right.
savings account or something
Yeah,
crazy.
you do have to maintain balances. Most of these though are not too bad. I mean, they're like $500 or 1,000,
Oh, okay.
but
So
and there's no minimum deposit initially on a couple of them. But these are special offers, and this is today. And I've done this before with Bankrate, and it does change. I mean, you could go on
yeah,
next week; it might be different. So yeah,
and they might change, especially if interest rates go up. To keep up with inflation, they might go up. So the pro is you get this safe. Really, it's a low risk. The big risk is bank fraud or something, the bank going bankrupt. But you got the FDIC insurance
yep, they
up to
are FDI
250,000.
insert.
Um,
Yep,
you get a fixed rate, so you know what you're getting. So there's no
yep,
surprises with a CD.
yeah. That's
And
why people used to love them.
yeah, and there's low penalties. So if I'm going to lock it up for a year, and you're going to get my 0.6% or whatever it is.
Yeah, and most
Sounds
of them,
terrible.
by the way, Dan, and you pointed this out to me before the show, but I will point out most of those that I'm quoting at a year are actually 18 months. So, a
So it's
lot
not,
of
yeah,
them, it's
yeah.
not,
They
it's
they
even
push it
over a year.
out,
Yeah,
because they're willing to lock it in. I mean, what's the risk to the bank? You lock in, and they're going to give you 0.6% for 18 months. The risk to them is that interest rates go down even more, and they can't even get that. But
but they're at rock bottom, so
they're at rock bottom.
that's
The
not going to
real
happen.
risk is to you, that it's not going to
Yeah,
keep up with inflation right
right,
now,
right.
or the rates are going to go up, and you're going to not be able to get the new rate because you're locked in for 18 months at the lower rate.
Meanwhile, the bank's able to invest and use your money to make more
More.
money
Right. But that's the name of the
during that
game,
time
Tony.
period. So, and I want to say you were right. There's a caveat below, even on bankrate.com. They say, just to prove your point, they say online banks tend to offer higher rates than brick and mortar banks.
Yeah,
So
they
for
don't have
these
to pay
higher
people.
rates, yeah. So for the higher rates, you got to go with the online only.
Right.
So, which is a little more risky because they haven't been around 200 years like the brick and mortar banks have.
Right. And, this is a retirement show, so people that are retired tend to be older. And so they're not used to the online banks as much as the
Right.
younger generation. So that's probably not a big deterrent for a 20-year-old. But a
Sure.
75-year-old might say, I don't trust the online stuff. So I think that's changing. But, but there's some good positive points of a CD. They have a purpose. But let's switch over to the cons, which are quite obvious. We've been bashing on them because they have really low rates.
Yeah.
They have a fixed rate, which is great. You'll know what you're going to get, but it's terribly low
Well,
compared
yeah. And
to, what else you can go, you know.
yeah. Well, I mean, if people want to know what they can make on a CD, all they have to do is look at your background and just count one, two. Just
Right.
count.
That's why I have the pennies here. Good point. I forgot to explain. I thought it was
Well, you said
self-explanatory
that
here.
you said a penny for your thoughts, and
True. But you
I'll
you
give you
give me
my
2 cents.
2 cents.
Yeah.
Yeah, yeah. I'll
That's a
give you my
losing
2 cents.
proposition.
I'll give you my 2 cents, but you got to give me a penny back for your thoughts, or I'll give you a penny for your thoughts. Yeah.
So, so you know, they the rates being so low, that's really the big con to this whole thing. The there's also early withdrawal penalties, but some of the alternatives, say like a fixed annuity, it's a set interest rate, fixed. Give me a fixed rate for 2 years. The penalty to withdraw from that is a lot higher. In a CD,
Oh,
it's
yeah.
usually you just forego the interest. 6 months of interest or a year of
But
interest.
anything
So
with
you
a
don't
term,
lose money.
Yeah, but anything with a term, you're going to have early withdrawal penalties.
Right. Right.
I know financial advisors, it's been pounded into your head, and you're by law required to say, when you talk about fixed index annuities or CDs, you have to say, there are early withdrawal penalties. But any type of retirement account or a term, if there's a term on your annuity or a term on your CD, which there will be, you have early withdrawal penalties. I find it it's just a fact of life. It's not like that to me isn't the biggest negative, because pretty much any type of savings vehicle where you can make interest, there are early withdrawal penalties.
Right.
Right?
Or a savings rate of 0.5% you mentioned. The probably
Yeah.
have a high limit you have to put in. So
Yes.
$50,000 minimum. If you go below that, you don't get it. You go from 0.5% to 0.05% or something. So there's some
Yeah.
penalty to withdrawing or lowering or something like that. The
Yeah.
other thing I mentioned on here is taxes. I want to talk specifically about that. When you buy a CD, you might say, I'm going to get 0.7% over the course of the year. And you might not touch that. You might say, just let it roll, let it ride,
Yeah.
compound.
Yep.
But you're still going to get taxed on it. So there's no tax deferral in a CD, which confuses people sometimes. Well, like if you buy a stock and don't sell it, you don't have to pay capital gains on it
Right.
because you
Obviously,
didn't sell it. But if
you
you get
didn't
a
make the profit.
dividend from that stock, you pay it, even
Sure.
if you reinvest it. So same with a CD. You're gonna have you can't kick the can. You can't buy a 5-year CD and not pay taxes until the 5th year. They're gonna 1099 you for it no matter what. So you get the 1099 DIV.
So if you have a 5-year CD, you don't pay all the taxes at the end of the 5 years. You pay every year on
You
what
pay
you've
every year. They
gained.
they can't defer taxes. So you're going to get a 1099 INT for interest. You might get a 1099 OID, which is original issue discount. So you might get interest. You might not have even see the interest, but still get taxed on it. So people, why is that? Well, because the IRS doesn't allow CDs to defer. A fixed annuity, say you bought a 3-year fixed annuity at 2%. You wouldn't pay tax on it until you took the interest. So there's some benefit tax wise to that. So CDs don't have that. So that's why I listed it as a con.
Yeah, because a CD isn't really necessarily a vehicle set up, with the idea of specifically retirement in mind, like other retirement vehicles like fixed index annuities and IRAs and
Right.
401ks. Those are all retirement vehicles, so they have that. CDs really is probably not that way, because they're not tax deferred, because they're not a retirement vehicle. They're just it's another savings vehicle.
Well, I'm glad you brought that up because that's the whole point of the show is how does this relate to retirement? Because CDs have a purpose. They're a tool. So you need to have a reason to buy a CD. You shouldn't buy CDs. A 20-year-old shouldn't be buying CDs for retirement. Now you can put a CD in an IRA. They call them IRA CDs.
Yep.
You go to the bank and they'll say, hey, I want a CD in my IRA. So they'll have a special CD in the IRA. You don't pay tax on that until you take the money out. So you do get the tax deferral if you want it from a CD. You'd have to put it in an IRA. But an IRA is for retirement. And if you're not going to retire in the next year, odds are you're not going to buy a CD because you need to have a specific purpose for a CD, and it's usually going to be short term, right? Because
Right.
the interest rates are so low. If you're going to push something out for 5 years, you're probably better off with a different investment vehicle than a CD, right?
Right.
So let's talk about retirement here because I want to bring up a few points about why people use these in retirement. The first topic I want to mention is laddering. This is a concept of, and you could do this with bonds as well, but with CDs, a lot of people ladder them, and what that means is they'll buy a 3-year, a 2-year, and a 1-year CD, all at the same time. And then after 1 year, that 1-year CD comes due. The thought is the 3 year is going to pay a higher interest than the 2-year, and the 2 year is going to pay higher interest than the 1 year. But you don't want to lock them all up for 3 years in case interest rates go up. So right now you might be saying, I like the idea of 3-year CD because I don't need the money for 3 years. But what if interest rates go up in the 6 months? Then I'm kind of stuck. So you could buy a 1-year CD. When it comes due, you buy another 3-year CD. And so that's going to mature 1 year after the next one. And you're laddering these. So every year one comes due, you buy another long-term 3-year, and you have a constant money coming due that you can then reinvest or spend. So that concept of laddering, people use in retirement to pay for income for the next year or two. So concrete example, Tony, you're 64 years old. You say, when I'm 65, I want some money to help pay for Medicare. So I'm going to put money now in a 1-year CD. So when it comes due, I will pay the Medicare premium with that CD because it's not going to come out of Social Security because I'm delaying that. And then I'm going to buy an 18-month so that I pay the next 6 months of premium for Medicare and so on. And so you have that money aside because you could put it in the stock market and make a whole lot more theoretically, but you could lose. So it's a risk, really close to risk-free way of having short-term money come due through laddering.
Yeah, I've heard about laddering, but I always had a hard time grasping it and making it really work for you. So I like the way you explained it there.
That's because the last time you were on a ladder, you fell off and hurt your shoulder. So
no, that's my dad who keeps falling off ladders. Yeah.
Yeah. Sorry. Too soon?
Too soon.
So income plan, coming up with an income plan is a big part of retirement. And part of the income plan is, hey, I need money in 6 months, 1 year, 1.5 years, 2 years. So this is where a CD might come into play because you don't want to invest it into something long-term because you need the money soon and God forbid it goes down, right? So a CD has its purpose. But, and it's a big part of income planning. And people might say, well, who would buy a CD? Well, if I need the money in 6 months, where else am I going to put it? Right? So a CD could be very useful there.
Yeah,
and the
short
last
term.
point there. Yeah, short-term income. You could, and then for 3 years you might have a different thing, bond or something, and then 10 years you'll have a stock mutual fund or a portfolio or something. So the last point I put in there about retirement and CDs is a lot of people use it as a placeholder. The term I'm using, people don't really call it that, but imagine it this way. My grandson is gonna graduate from high school next year, so I want to give him a gift of cash. I'm not going to buy him a gift because he's going to say this isn't what I want. He might want to buy a car. He might want to, pay for college, whatever. So I'm going to put this money aside, and while it's sitting there, I'm going to put it in a CD that's going to mature when he graduates so that as soon as he graduates, the interest is paid, boom, give it to him. So, or it's like the Christmas fund, or people use it for taxes. I got my tax liability. I usually pay in April. I'm going to buy a 6-month or a 2-year CD to coincide with taxes that come due. So I know it's there. Because for some people, Tony, they like to spend the money that's in the bank account. But if it's in a CD, they are reticent to take that out because of the penalties.
Yep. So it's like a way to protect your money from yourself. And I noticed you specifically said that.
I didn't say anything. I can't. Did I say that?
I can't I can't spend it on a record shopping spree or go to the
Well, you could, but you'd pay penalties, and your risk. You don't like. No one likes paying penalties. No. So you'd be like, oh, I wish I could do it. So.
Yeah. So, and I know, growing up and even like my mother-in-law, they use CDs to put money in for the grandkids' college. And then when they graduated high school, they got that money to put into their 529 or for a college fund. And so, 5 years before they put it in a 5-year CD, blah, blah, blah. Now, I know a lot of older people do that because they're familiar with CDs. But nowadays, in the last 20 years or 25 years, that's probably not the best idea because if you have a 5-year or longer time horizon, you're much better off, probably with some type of conservative portfolio, or I mean, even
Well, let's talk about some alternatives. Yeah, I
Okay.
wish my, like we took savings bonds. My grandmother used to give me
Yep.
savings bonds, right?
Yep.
That's an alternative. Money market.
Hmm.
You know, what a money market's paying. They're pretty low too.
Yep.
Typically, a CD pays more than a money market.
Yeah. Money
Short-term
markets.
bonds work.
Yeah.
Treasuries, like a short-term bond, you could buy a 1-year bond. Now, if you hold it for the full term, there's risk in bonds, but if you're going to hold it for the duration, 1 year or 2 year, and you
Yeah.
mimic a CD, a bond will probably pay you more.
Yeah.
Different risks. It's not going to be as riskless or risk-free as the CD will be, and it's not going to be insured, FDIC. But
Right.
if you're talking about a 1-year treasury note from the government,
Mhm.
that's about as risk-free as you can get.
Yeah.
But typically you got to shop around. Right now, it's 0.7 or 0.6 or 0.5. What's the difference?
Yeah.
Really,
Yeah. Honestly.
I
Yeah.
mentioned fixed annuities. These are not the bells and whistles, nothing fancy here. These are just give me my interest for a certain period of time. They call them multi-year guarantee annuities or
Yep.
MIGAs. You might get 1.7 for 2 years versus a CD paying 0.7 for 2 years. So,
Hmm.
but again, that's not insured. It's with an insurance company, but it's not FDIC insured. It's backed by the claims paying ability of that insurance company. So you got a different
Yep.
type of risk. But I put on here an alternative to CDs because this is big, and I always like to bring this up. Pay off debt. Do not buy a CD for 18 months if you have a credit card bill that you haven't paid off.
So you're paying 14%
Right.
for a credit card bill, and you're making 0.5 or 0.7% on your
Right.
CD. It doesn't make sense.
Right. Even if you're paying a car loan at 1.5% or 2%, you're better off paying that loan off sooner than buying a CD.
Yeah.
Because you're making less is going out, So people forget this, and I always want to bring it up because people forget that it's all about cash flow, money in and money out. You're giving money to a bank, they're giving you basically nothing in return. I'd rather give it to the loan company and pay off my debt instead of giving them money.
Yeah.
Otherwise, you're just giving it from the bank and you're losing. It's, again, a penny for your thoughts, but 2 cents you got to put in to give it. So it's a losing proposition.
Yeah.
So to conclude, a CD is a tool. It's a tool. There's a lot of different types of CDs, different settings, years, terms, interest rates, so on. I remember when I was helping people in the early, like 2010 and 12, 2013, they had a 10-year CD coming due that they were getting 6% on or 5%. And they're like, oh my goodness, why am I getting rid of this? Because the banks aren't offering them anymore. Back when they bought that 10-year CD at 6%, interest rates were a lot better. They were probably like, who would buy a 10-year CD at 6%? Right now, I would. Right?
Yeah.
But then no one's offering it. So
I would too. If that was offered, that's where my money would be.
But I doubt people are going to say in 10 years, oh my God, I should have bought that 10-year CD at 1.2%. I just don't see that.
No.
So right now, CDs aren't very attractive right now.
No.
People are leaning more toward fixed annuities.
I'm shocked
or
they
bonds.
could even sell a CD, but you're right. You gave a few points as to why.
No,
somebody might
they have a
want 'em.
purpose.
Yeah.
Is it going to be for a specific purpose? If so, then a CD might be the best tool. But make sure before you buy a CD right now, it is the best tool for the job. Look at all the options like we talked about. And if it works, it works. Then don't have regrets. And don't feel like because you have money in CDs, you're wasting it. You know what's wasting it is if you have a credit card bill or if you're just sitting and checking. That you're not getting anything for. But sometimes, even cash in hand, we did a show on gold, which you weren't there for. It's sometimes good to have physical
I saw it.
ability of having money in your bank. The pennies in behind me in my coin jar. There's something to be said about that. If I need
Sure.
to go to the store and do something, I got it. Boom.
Liquidity.
Liquidity, right. So don't feel obligated to get a CD. Just remember, don't pull your hair out if you're worried about 0.6% versus 0.7. Yeah, as a percentage, it's higher. But really, what are we really talking about in the long run? $1?
And it doesn't matter how many CDs you have. It's still,
Right.
it doesn't, I mean,
A crate of CDs?
Ooh, who was that? Who was that?
I forget that actor's name.
A crate of CDs?
Sounds like a New Yorker.
Yeah, I forget his name, but he's great. He's in
Do you
one of
think
those.
he owns CDs? Probably not. So,
No.
Tony, that's how we're going to end it. I'm surprised we were able to talk for 20 minutes about CDs. We went for almost a half hour. How is that possible that we could talk for a half hour about CDs?
Well,
it's just amazing.
yeah, I mean, because it's crazy. People think about seats. I think especially seniors, and I'm not picking on, I'm almost in that category myself, but at this point, but, my parents, my mom's parents, these people still, I'll buy a CD for the kids. It's like,
Right.
yeah, you might want to do something else with that money. Put it in a
Yeah, and your kids are
529.
like, your kids like grandpa. Well, great grandpa, that won't even buy a pack of cigarettes. That's what your kids are saying.
They're not saying that, Dan. No tobacco use in this family.
All right. On that note, Tony, thanks for a good show. And I think right now, you buying your CDs is probably a better option than buying a certificate of deposit.
This is a better investment than
it probably will go up in value.
Yeah.
At least the talking points are more valuable, the conversation value.
Yeah, and the kids out there are going, "What is that, Dad? What do you got there? Is that a coaster or a little hand mirror?"
All right, Tony, thanks for a good show, and go shop some more CDs. We'll see what happens. By the time the show comes on, maybe CD rates will go up.
Maybe.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Whittle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.